Hi, and welcome again to the market dashboard for this week. Quite an uneventful week, to be honest, despite the fact that we are finishing the pretty significant months on the S&P 500 plus 6.2% at the end of this month, which is the best month since November 2023, and it's actually the best month of May since 1990. So pretty interesting month specifically for equity, recovering from the early rout in April. And on the bonds side, this month we hit the 5% of 30 years yield in the US, which seems to be the limit that the markets are seeing at this time for the interest rates. Besides that, this week was pretty uneventful and appears to be more of a normalization week, and we'll see that right now. If we look at the major asset classes on the dashboard, we see that we still see the pattern of equities, bonds, and the US dollar being in positive correlation behavior. At this time, they are all bouncing back at the same time here, when they were all losing at the same time earlier this year. And so we see some more risk on behavior, and the risk off is taking a step back, with gold receding at this time, even Bitcoin receding. The oil is a bit different because Saudi Arabia announced an increase in its production, so obviously it weighed on oil prices at this time. But if we look at some of the metrics that we have been looking at over the past weeks and months, which are activity ratios on volatility ratios and volume ratios, they are back basically around their equilibrium levels, which means that we are normalizing at this point. So if we move on, then we can see again normalization here on the global activity ratio, which gather all the activity ratios between all asset classes, and we are back to, let's say, regular level, at least some of the levels that we've seen since 2023. We are in a range right now where we are in a period of normalization. And this is confirmed by basically everything that we see, all the charts that I will show you today. If we look at the equity sectors, we don't have any equity sector overperforming or underperforming. The other ones, it was quite even across all sectors except maybe energy. As I mentioned, the Saudi Arabia decision to increase its output of oil, which weighed obviously on energy stocks. This is similar on this one, when we see that the defensive sector are not either overperforming or underperforming. It kind of flattened the last 2 to 3 weeks. So we are not in a situation where investors are switching from risk on to risk off. It's again kind of normalizing. I will be probably repeating this all along the couple of minutes we'll stay together. It's again similar here. When we saw at the beginning of this year that money was leaving the US markets towards more reallocation to foreign markets, European markets specifically, it seems that this trend has stopped. Again, a sign of normalization, where the performance of foreign specifically European stock markets are in line with the US stock market as well. And by the way, I wanted to mention about this that if the US is recovering in terms of performance with the S&P 500, the weakness in the US dollar makes it really different for foreign investors because when we are nearing the all-time highs on the S&P in US dollars, because of the weakening of the US dollars, I think if you calculate the S&P 500 not in US dollar, based on DXY, which is the dollar index versus the other currencies, then the S&P 500 is still down or less than minus 10% at this time, which means that for foreign investors, the US equity markets has become, because of the weakness of the dollar, less attractive. It's very different from what foreign investors have experienced since 2020 to, let's say, 2024, July 2024, about this, where we had stocks going up and the US dollar going up. So foreign investors were winning on both sides at this point. So we see this on equity markets, foreign equity markets. We see the same thing on major currencies. You can see that the US dollar is not smashed anymore. All currencies versus the US dollar are flattened. The US dollar have flattened as well, so kind of normalization as well. This is again very similar when you look at major asset classes versus gold. You see we had dramatic overperformance of gold in a risk off flight to safety since the beginning of the year. Over the last 4-5 weeks, this has stopped and gold is not overperforming again, meaning that the risk on sentiment is coming back on the market, or at least it's not a total risk of sentiment. Again, another sign of normalizations, and all of them are going into the same direction. The last thing that I wanted to show you is again TLT here, which is around 40-something% drawdown at this point since the top in mid-2020. Why? Because this is again the market to look at. Like I said, the market bounced back on the level that we hit at the beginning of this year. It seems that again the 5% interest rate seems to be a limit for the market. At this time, the market don't believe that will go above 5%, and the market bounced. Now, given the continued spending in government, and we see this with the big beautiful bill, Trump's big beautiful bill that will continue government spending, and this will be the key to monitor because if government spending increases and interest rates increase as well, we've seen what happened on the credit rating of the US, meaning that if the government spending increase, the investor will need, let's say, higher interest rates to cover the risk of not a default, because again the US cannot default, it can always print, but it would be kind of, if you start printing to pay back your debt, it's a technical default anyway, which means that investor will ask for higher interest rates to cover that risk on the currency. So that will be the thing to monitor, because at some point it will have an impact back on the stocks as well. And any crisis on the interest rates, the credit market is the basis of the economy. Everything depends on it, stocks, everything. So this is definitely the smart market to monitor. Again, very good months in May for stocks. Not so much for bonds. The interest rate was still up for the months of May, so not so good, but we'll take it. In terms of seasonality, even if May this time was a really good one, usually in terms of seasonality, June has been the worst month over the last 2 decades, worst month of the year of the last 2 decades, so this will we'll have to be cautious again on this. But what we've seen so far over the last week, and even couple more weeks back, 2-3 weeks, we are seeing some normalization on the market. It's not a total risk off like we've seen. We are not totally back risk on. Probably we would have to make new highs on the stock market to go back to some risk on, more obvious risk on behavior on the market, but we'll monitor that, and we'll discuss that over the next week. Thank you. Bye bye. Enjoy your weekend.